When it comes to selecting a financial advisor or a financial advisory firm to work with, what are the key elements that you should be asking and looking for as you go through that process? Okay, so I'm going to break this down into two segments. Firm level characteristics you want to look for and advisor level characteristics you want to look for. And interestingly, the firm structure, I would argue, is more important because if you get those elements correct, then you know any advisor that's working with that in that firm, under that umbrella, you know that they're kind of operating in an already optimal setup for clients, right? And so therefore, there's less to necessarily pin down on the advisor level itself. Okay, so what to look for first at the firm level? Okay, so there are 7 categories here. Number 1, registered investment advisor. Number 2, fiduciary. Number 3, fair and equitable fee structure. 4, independent. 5, practice, focus, and scope. And then 6 and 7, financial planning and investments. So let me run through each of these real quick. Okay, so registered investment advisor, or RIA. This is the legal structure that the firm operates under. And what it means is the firm has to register with the states that it has clients in, or it has to register with the federal government, the SEC, if it has more than 100 million. So if you have less than 100 million, the RIA has to register in the states. And if you have 100 million or more under management, you have to register with the government, federal government, SEC. Okay, why is this important to the consumer? You want to be at a firm who has to answer to somebody, right? They have to answer to the state or they have to answer to the SEC, right? There are compliance requirements at the state level. There are compliance requirements at the SEC level that these firms have to follow. And all those compliance requirements are simply designed to protect one thing, the consumer, right? So you want to work with an RIA because you know that they're going to be registered at one of those 2 levels. What to look out for? If you are not working with an RIA, oftentimes it's someone who's kind of, they hang their shingle out and you sit down to meet with them and they will ask you to write a check to them personally or to their firm. This is such a red flag. You want to politely stand up and walk away. An RIA will never, ever ask you to write a check to them or any individual at that company. If you are ever being asked to write a check to an individual or the company, this is where people get money stolen, right? And that company is not registered, and they can do whatever the heck they want with that money. Maybe they'll do exactly what they tell you they're going to do with it, but you have no way of knowing that. The RIA structure is a regulatory shell that protects you from that. Number 2, fiduciary. Okay, this is extremely important. This is the legal obligation that the firm has to its clients, right? And very simply, it's the highest standard of care in the industry. The corollary to this would be something called suitability. Fiduciary responsibility simply means you have to do what's in the best interest of your clients at all times. And it's silly that there's anything other than this, in my opinion. But again, the corollary to this is something called suitability. And that level of responsibility does not require that an advisor does what is in the best interest of their client at all times. It is bizarre to me that even exists, but it does. So you as the consumer really do need to ask the question, Mr. and Mrs. Advisor, does your firm have a fiduciary responsibility to me or a suitability responsibility? It should 100% be fiduciary all the time. Anything less than that, politely stand up and walk away. All right, number 3, fair and equitable fee structure. This is a big one for us. All right, so the normal approach in the industry, the RIA industry, would be to charge on average, like call it 1 to 2% of assets. 2% is getting quite high. 1% is normal, considered normal, and it's just simply the firm is going to charge you 1% of all of the assets that they are managing and helping you with. This is called a wrapped fee or a pure percentage model. Now, I'm not going to get into my disagreements with the wrapped fee model necessarily here. Bottom line is the 1% is a very good evolution relative to the commission-based world that the industry really used to operate in. So it's an improvement. But the bottom line is you really want to be plus or minus 1%. Now, optimally, this is my opinion, you really want to work with a firm that has more of a fixed fee structure and a lower variable asset-based pricing model. The more the dollar cost is fixed relative to a lower percentage pricing, as accounts grow, there's just going to be less of a fee drag on the accounts. When you have a pure percentage model, like 1%, that fee drag will just continue on as time goes on. Anyway, if you find a 1% guy or gal, you know you're operating with an industry norm. Optimally, that is more of a fixed fee and a reduced variable fee though. All right, number 4, independent. I refer to this as the mothership, right? Bottom line is whatever firm you're working with, you want to make sure that they are answering to you and not some other large firm out there that controls them, right? The advisor or the advisory firm should be able to go out into the industry to find whatever product, service, or solution is best for the client. You don't want them to have to sell or provide something that comes from, again, some higher level entity, right? Like a certain investment products that come from like if they're affiliated with a mutual fund company and they have to sell those mutual funds. You don't want that. Or an insurance company, heaven forbid, they have to sell insurance products that come from that company, right? You want a truly independent advisor who can go out to the market to find what's best for you and implement that. All right, practice, focus, and scope. This is an important one. And it's kind of broken down into 2 subsets. Really, you want to make sure the advisor to households served ratio at a firm is about 120-ish, plus or minus. Think of this as if you're working with an individual advisor, there's no larger firm that they're working with. You really want that individual advisor to have 120 households or less. At a firm level, again, that ratio should be for every one advisor about 120 clients. Why is this important? Bottom line is that in a given year, there's really not enough time to do what you need to do as an advisor for clients if you have more than 120 households you're trying to do it for. That's the gist there, right? It's just a capacity thing. There's just, again, you just want to work with somebody who's not constantly trying to bring on more, or a firm that requires advisors to bring on more, right? If you're the 121st household, the 130th household, the 150th, the 200th, the 700th household, right? You just know that there's a low likelihood that advisor has the capacity to really do what they need to do for that many households. Number 2, you want to make sure that the advisor has a focus area, right? So Equitable, we work with primarily physicians. And when you have a niche focus like that, whether it's physicians, whether it's business owners, whether it's anything else, you as a consumer just know that you are getting a certain level of expertise as opposed to broad advice for the kind of the masses. The more focused that an advisor is, the more focused a firm is, there's scale there that you get as a consumer. All right, the last 2, these are the quickest: financial planning investments. Okay, so most RIAs will generally always focus on investments, right? That's kind of a box that can be checked. What you don't see as often is a focus on financial planning as well. And this is so important, right? Financial planning, this is tax mitigation, this is liquidity, this is retirement, what accounts you have, why you have them, how are you funding them. These are all things that go into financial planning. And there is a ton of value in planning. So you want to make sure that your advisor has a very, very high planning focus. If they had, so I'll come to this in a minute, but if they have their CFP designation, they likely are. But don't let an investment focus come at the exclusion of financial planning. On the investment front, the final bullet point here, you want to look for a firm that employs, in my opinion, some version of modern portfolio theory. That's the key term there. And modern portfolio theory is just nothing more than a prudent and academically founded investment approach, right? Everyone and their mother has a theory on how to invest money, pick stocks, market timing, sector picking, whatever it might be, right? The challenge with any of those things is they're very difficult to repeat, scale, and be successful at, right? Modern portfolio theory solves a lot of those problems. So arguably you want to work with a firm that is employing some version of modern portfolio theory. Okay, so that wraps it up on the firm structure side, right? Registered investment advisor, fiduciary, fair and equitable fee structure, independent, limited practice size and scope, and an emphasis on financial planning, and on the investment side, modern portfolio theory. So now that we just went over the firm level structural characteristics, right? If you hit those, you can be sure that you are operating, that you as a client are in a firm that is structurally set up to really optimize things for you, the client. That's the most important thing, right? Once you've checked those boxes, then it just comes down to the advisor that you're going to be working with yourself, right? What are the characteristics to look for in that individual person? A lot less here, actually, right? Again, if you are working with an advisor at a firm that embodies those characteristics that I just mentioned at the firm level, you can be sure that that advisor is really in a place that's designed to benefit clients and optimize things for clients. Okay, so advisor level though. 4 key pieces here, or four things to look for: educational background, designations, personality, and record. All right, so number 1, educational background. Okay, this is an industry that unfortunately has a very low threshold of entry. So basically anyone can get into it if they want to be an advisor, with almost no background needed. So generally speaking, you want to ask your advisor if they have some background in business, and optimally within business, you want them to have a degree in finance, economics, or accounting, right? These 3 are just more technical degrees, and given the technical nature of financial planning and investments, again, you want someone that has a background or has studied and kind of excelled in those areas. Of course, outside of that, you get into like math, physics, other degrees outside of the business school. I would actually argue that's just as good. The key here is a technical background, right? That's what you want to that's what you want to look for. Now, I'm not saying that someone with a marketing degree or a fine arts degree or a communications degree can't be a good advisor. They absolutely can be. As a consumer, though, I'm just simply suggesting that it's very hard to delineate whether or not that person is good or not relative to someone who has a finance, accounting, or economics degree. And again, you can run into plenty of advisors with finance, economics, accounting who aren't good advisors, right? But I'm just trying to give us a loose framework to think and operate within. If it were me, knowing what I know about all this, I would absolutely be looking for someone who had a more technical degree under their belt, or degrees. Number 2, designations. Optimally, you want your advisor to have the CFP designation. That stands for Certified Financial Planner. This designation is only held by about 20% of the industry. And in my opinion, it's the only real way outside of educational background to know if you're working with a competent advisor, right? The CFP has real academic rigor behind it. It's the equivalent, I would say, to working with a CPA for your taxes, right? There are plenty of people who do taxes who don't have their CPA. But if you work with a CPA, you know that person has crossed a bare minimum threshold of knowledge and ability relative to anybody else. It's the same thing with the CFP. When someone has that CFP, you just know you're working with someone who has crossed that bare minimum threshold of what should be expected from an advisor. And again, it takes quite a bit to pass those tests. There's a reason only 20% of the industry has it, because it's a very difficult set of 7 tests to get through. But it does focus on all the key areas of being an advisor, right? Investments, retirement, insurance, ethics, and kind of comprehensively. It's been a few years since I've passed this, so I have to go back and look at all the subject matter. But it really is the only discernible way for the general public to know if they're working with a competent advisor or not. All right, number 3, personality. This is simple, right? There's no objective measure for this where you can like look at a piece of paper and know whether someone's the right personality or not. But simply, like when you're sitting down and working with somebody, it should feel right. And there's been a number of times in my career where, on paper, the client was great for us. We were great for the client. But there was just a disconnect in how the personalities meshed, right? And that is okay, right? The bottom line is you want to look forward to meeting with your advisor because there's a personality mesh there. If you don't look forward to it because it just doesn't feel right when you're with them, just find somebody else. I'm as an advisor, we don't want to work with someone where there's not a personality mesh. It's a normal thing. It's just finding the right person. And last but not least, a clean record, right? You can look this up at the SEC's website or FINRA's website, but the firm or advisor you're working with, you just want to make sure that person has a clean record. They're not getting sued up and down by previous clients. There's not regulatory issues that they've had. This is a fairly easy thing to discern, but it's just working with someone who isn't riddled with regulatory issues or client issues. So again, to wrap up on the advisor side, educational background, CFP designation, personality match, and then clean record. If you can hit all those things on the firm level and all those things at the advisor level, you can be rest assured that you are in a phenomenal setup and that whatever that relationship is going to be built on success from that point going forward. If any of these categories are missing, truly, you really want to, it's buyer beware, because it's arguably probably not the optimal setup, and there are plenty of optimal setups out there at the firm and advisor level. Anyway, this is James signing out, and thank you for your time as always.